Welcome to Retirement on the Shore. Thanks for tuning in. We are your hosts, Nate and Bryant, certified financial planners with CFS right here on the Eastern Shore. We specialize in helping people who are approaching retirement or already enjoying it make confident, informed financial decisions. Let's jump in.
All right, welcome back to the Retirement on the Shore podcast. We are your hosts, Nathan Canada and Bryant Zimmerman. Looking at the camera now, it looks like Bryant has gotten some sun over the weekend.
Yeah, I went to the beach on Sunday, so I stayed out there a little too long, but
Sunscreen?
Yeah, I did use
You
sunscreen.
Okay.
Got a little bit of vitamin D, so
Got to up that SPF next time.
Yeah, I would say, or apply it multiple times.
Got a lot going on. Bryant is actually taking his talents to Salt Lake City in a few days. I guess we're all going, but Bryant's the only one really taking his talents there.
Yeah, I guess.
So yeah, we have a conference coming up in Salt Lake City, so we're gonna be out there for a few days. There's some talks of a potential live podcast while we're out there. Maybe grab a couple special guests. Who knows? We'll see what happens when we get out there, but hopefully we can try to get one while we're there.
I think we definitely want to do a Q&A. So if this gets out before we go, email us some of your questions.
Yeah, feel free. There's already been a couple that have come across our desk, so we'll touch on those. But we'll also, we'll kind of jump into some common questions we get throughout our meetings. But for today, we kind of want to jump on here. So we're halfway through the year, actually even a little bit more.
We're a little bit over, but yeah.
Yep. So we kind of wanted to go through some mid-year tax planning. So if you haven't really looked at it, there's still 5 or 6 months. You have some time to, actually, I guess 4 or 5 months now that you can, try to catch up if you're not where you need to be tax-wise, kind of see where you are at. And that's kind of where we would come in and help. Feel free to reach out to us, email us, call us. We can always kind of help with your individual situation as well.
And 4 months goes by quick, so don't wait until December to try to do some of this, because at that time it's too late. There's a couple things that we'll talk about, especially withholdings.
Yep, so we'll jump right into it. So main thing is the withholdings. So if you've had a big change in 2026 tax year, whether that be retirement, or you no longer have a dependent, they're off doing their own thing now, or you have a part-time job, anything that could really change your taxes, starting Social Security is a big one.
Yeah, another big one is when you turn 65, the senior deduction or the senior credit, where you get an extra $6,000 if you're under the limit. And that can definitely change your withholdings. Maybe you don't need to withhold as much. There's a lot of different things you need to think about.
And sitting on this side of the desk, so our whole goal is to try to get everybody as close to zero come April as possible. Obviously, we would err more on towards the refund side, I guess. But we don't want to see a huge refund. We also don't want to see anybody get a big surprise.
We don't want big surprises, because that's not a fun conversation.
So as close to zero as you can get, the better. That's the whole goal. So kind of with the withholding. So we've seen a couple, this kind of seems to be a hot topic, at least in a lot of my meetings right now. We'll give a couple examples. So retirement, let's say you worked 3 or 4 months this year, and then you turn on Social Security, your income's probably dropping. So if you have this, if your withholdings for Social Security are in line with what you were withholding at your W-2 wage, probably going to get a big refund. So, Social Security isn't fully taxable a lot of times. It's either
depends on the income.
Yep, it's either 0% taxable, 50% taxable, 85% taxable. But either way, probably going to drop. So we don't want to see a huge refund. Let's say you got a part-time job of you're making 10 grand, let's call it. That employer will see that you're making 10 grand with us, and they will say, okay, well, you're in the lowest tax bracket. We're not going to withhold anything. And then, that's on top of a $100,000 wage or whatever it is, and they're under withholding. Then come April, they're going to owe $2,500 on that 10 grand that they should have been withholding for. So mid-year, you probably won't be able to catch up fully, but you can go to your employer and say, hey, you need to start withholding X amount of dollars. Try to play catch up within that 4-month period. That way you're not getting a huge surprise come April next year.
And the form to do that on, I believe, is W-4.
Yep.
Yeah. W-4. So if you need to do that, the employer can supply it, or you can just go on the irs.gov and download the W-4.
I will say, not our most fun form to fill out. It's a tough one to fill out, but we can help with that. If you have any questions or anything with it, feel free. So, I mean, withholdings is the biggest one. I mean, it could go the other way too. You're withholding too much. You've been getting a $6,000 refund year after year. It's kind of giving the government a tax-free or an interest-free loan essentially, which we don't want to see that a ton either. So
Yeah.
maybe you back your withholdings down. Maybe you're not making as much. You stopped working that part-time job. You can back your withholdings down with your current employers.
Yeah, there's a lot of things to consider. Everyone's different.
Yeah.
Some people have part-time pension, Social Security, so it's definitely individualized. So just be mindful of everything. And that form kind of lumps everything together, and you could do it online as well, where you can put everything in. It's a lot of things you need to know, but it'll help out if you do it online. It's a little easier. I've done it a couple times. You just gotta make sure you have all the information correct.
So I mean that's where it all kind of stems from. So I would just spot check. It's call it August 1st right now. Say, okay, is anything different this August 1st than it was in my life last August 1st? Am I married now? So that's going to increase the standard deduction. There's a lot of changes that could be happening throughout, tax-wise and in like your personal life.
And even if you don't do that now and you wait till the end of the year, make sure when you do your taxes to do it then, because that's when it's top of mind.
Yep.
So, you don't have to do it mid-year if you're not quite sure what it's going to look like at the end of the year. But when you get your taxes completed, make sure you do it then. And that's typically going to be around March or April. But now's better. And
now's better because you have that extra 4 months to kind of make up some ground.
Yeah, and if you know you have to owe estimate payments, make sure you pay them as well so you don't owe at the end of the year. But withholdings definitely is a thing we deal with a lot just because people switch jobs, people retire. There's a lot of different income or less income, so things change. So just make sure you adjust and be adaptable.
Next, kind of, I guess, second biggest topic would be capital gains.
Yeah, capital gains is kind of we focus on that kind of throughout the year, depending on what the market's doing. But for taxes, it's important because if the beginning of the year you had some losses you captured or you had some gains that, hey, you needed a new roof and you took out and you have some gains, paying attention to that because depending on your income, you might owe at the end of the year and adjusting your withholdings because a lot of times you can't withhold on the distributions to your bank. So at the end of the year, you get your 1099 div or 1099B, and then you owe from the capital gains that you forgot about that you sold in the beginning of the year. So be mindful of that, and that's where the withholdings can help too, where you can adjust your withholdings for your W-2 wage to help offset that capital gains.
So yeah, I mean that's a really good point. So you might be over withholding, like if you look at all your W-2 wages, but it's to make up that ground for the high interest or the dividends that you have receiving outside of your normal W-2 job. That's a good point.
So if you're in the 12% or lower bracket, you could potentially owe 0% taxes. But if you're above that, you'll be in the 15%. Obviously, look up the range depending on if you're married or single. That can definitely depend on whether you need to adjust your withholdings. Maybe you don't. Maybe you captured a little bit of gain and it's at the 0%, so you don't have to worry.
That's super important. Let's say for whatever reason maybe you retired or you stopped working half this year, your income drops significantly for whatever reason it is. Be able to capture some of those gains at 0% and then get back to your normal job or whatever else after starting 2027. That's huge. I mean, that could save a ton of money in taxes.
Yeah. Well, we actually, if people retire in the beginning of the year and they're like, you know what, I'm going to start drawing from some of my brokerage account. We capture some gains because they're in that limit. Yep. And then sometimes they go back to work. They're like, I'm bored. I just, I want to get out there. I want to have a part-time job just to stay busy. And then we're like, shoot. We kind of captured some gains and now you're over the 12%. And then you just got to be mindful of that. So that's where the mid-year, you can kind of adjust where at the end of the year, you're not having a big tax bill, which we don't really like seeing. So
really good point.
Yeah. So just being mindful, and mid-year is a good time to adjust. That's why we wanted to do this podcast. There's a couple other things we wanted to kind of lay out.
Yep. So I kind of want to jump into the next one. So IRA contributions, 401k contributions, couple different ways we could go here. But let's say you're religious about maxing out your Roth IRA every year. So this year you're putting away, what's it, $600 a month you can be doing? Close.
Just 7,500 under 50.
Yeah.
$8,600 above 50. So
let's say
whatever
that
that
you're
is
putting
divided by
in
12.
$600 a month, to max it out. Last year, that would be perfect. Let's say this year it jumps up, the Roth IRA contribution limit. So you can contribute an extra $1,000. Now, you've been set on contributing $600 a month. Now it goes up. You're not going to be maxing it out this year. So looking at that and say, okay, hey, I need to call my advisor. I need to go online and increase what I'm contributing. And mid-year is a really good time to do that because you have an extra 4 months to increase it more, then back it down in January again.
What we see a lot is a lot of times people put in systematics where they just set it and forget it, which is great because you don't have to worry about it at the end of the year, beginning of the year. Every month it goes in, and that's what we like. But sometimes you hit a couple milestones where you turn 50, all of a sudden the contribution gets higher, or the IRS will increase the limit. So that's where it's like mid-year, let's adjust. See how much you've contributed for from January till now, and then kind of see what you have left and make sure either try to keep it the same and maximize it at the end of the year, which for Roth IRAs and IRAs, you do have until April 15th or until you file the taxes to maximize it. But it's nice to just get it in and not worry about it then. The other point is 401ks. So where Roth IRAs and traditional IRAs, you can contribute, as you want. 401ks, you kind of only can do it through salary deferrals. So this is where you need to make the adjustments.
No lump sum. You can't write a check to your 401k to contribute to it. Yep.
Yeah. So now you do need to make the adjustments so you can maximize it if that's what you wanted. Also, if you're over a certain age limit, your limits are different. It also depends on if you're in 401k or a simple IRA. There's different limits. So make sure you look at the limits and that you're on the path to maximize it if that's what your goal is.
Yep. Another thing with the IRA contributions. So let's say, you're halfway through the year, your savings is built up higher than what it's normally been. You're looking at your income and said, okay, I got a raise this year. I've worked a little bit over here part-time. Our income is maybe jumping into another tax bracket. If you have extra savings laying around, you can say, okay, I'm going to contribute $4,000 to an IRA, traditional IRA, to bring our taxes down a little bit closer to where they were last year. That could make a big impact if you're jumping up a tax bracket.
Yeah, that's where tax planning kind of helps, where you can kind of see where you're at and make adjustments. Because you can lower yourself in a certain tax bracket by just doing them, if you're capable of doing it. So, just making adjustments mid-year. It's kind of important, especially if you're trying to maximize your investments.
Yep. Couple more smaller ones. So QCD, Qualified Charitable Distribution. So this is something you can do if you have a required minimum distribution. So once you turn 73, you have to start taking money out of your IRAs. So let's say we're halfway through the year. I don't need the money. Our income's looking like this. It's a little higher. So maybe you say, okay, this year I've never done a QCD, but this year let's say, okay, I'm going to give my entire QCD, $5,000 straight to the church. We're already contributing. We're already tithing to the church. We're just going to give that money directly to the church. You're not paying tax on that money, so it kind of keeps your income the same, rather than taking that $5,000 as income to you and increasing your income for the year.
So when you do that, you got to make sure it's a nonprofit. So you can't just give it to your friends or
church, charities, humane society.
Yeah. So and RMDs, it's even if you're not RMD age, as long as you're 70 and a half and you're like, hey, I'd rather take out of my IRA, keep the money in my pocket where it's at, because I can keep that in savings and send it there because it comes out of your IRA tax-free and it goes straight to them and there's no taxable event. So
really good point.
You don't really have to wait till 73.
Kind of debated whether or not throwing that out there in this podcast, but I felt like it was important. We're going to be doing another, whole charitable giving podcast. That's a longer full episode just on that, but we don't wanted to touch on that just in case. Last one is Roth conversions. I don't know if you want to touch on that at all.
Yeah. So a lot of times, if you're planning for taxes and you know where your taxes are, getting like now into the end of the year, you can kind of plan on if you're able to do them, because you don't want to do the Roth conversion and create taxes, and then at the end of the year, you're like, well, I made way more than I wanted. I had a lot of unexpected taxes, and then you can't pay for it. So
it kind of goes back to Bryant's example where we had somebody retire, 6 months later they're bored and get a job at a golf course. if they did a $30,000 Roth conversion January 15th,
Yeah.
they weren't planning on going back to work,
Mm-hmm.
and then they do go back to work, your income jumps up.
Yeah.
Now, if you're halfway through the year, I haven't done a Roth conversion yet, I was going to wait. Now I know I'm not going back to work. I love taking care of the grandchildren,
Yeah.
having the full retirement experience. Now you can say, okay, I'm going to do a Roth conversion this year. Why not do it in August? Have another 4 months of it growing tax free rather than waiting till December.
Yeah, and we talked at length in a podcast before. If you want to go rewatch that, because we don't go too deep into the Roth conversions again, but we think it's a good practice to take some taxable money pre-tax and put it into the Roth IRA, where you can put it in after tax and let it grow tax free. So definitely thinking about it and planning out and seeing whether it's worth it to you. We can also help if you're not sure. Feel free to reach out to us.
Yeah. So, I mean, as you can see, if you listen to all three of these podcasts so far, I mean, the common theme is taxes and investments go so hand in hand.
Yeah.
They are really, I mean, it's like 50-50. You can't plan one without considering the other.
Well, it's important because if you start taking out of a traditional IRA, whether it be an emergency or, you go on vacation or, so on and so forth.
Bills, yeah.
It's you got to be tax mindful because you can start including Social Security be taxable, or you can get into the IRMA brackets. There's a lot of things that factor in, so it's just being mindful while you do this, and that's what we like. We do investments and we have tax practice, so it's nice to look at that as like holistically to make sure you're not getting a tax surprise at the end of the year. So.
Yep. So I mean that kind of covers the main topics we wanted to hit on today. If you have any questions or want us to look at your individual tax situation, feel free to email us. We're using the retirement@cfsfinancial.com email, or you can call us. Our office number is online. Just look up CFS Financial. But yeah, I mean, those were the main topics we wanted to hit on, obviously. So if you have a question or anything, feel free to reach out. But if not, be on the lookout for the next podcast. Hopefully we can knock one out while we're in Salt Lake City for the conference.
Yeah.
Anything else? Signing off.
I think that's all for today.
Great. Thanks for listening. Have a good one.